How much can you make doing this by yourself?
It is very simple, and it's a great way to get started. I think you can beat JEPI and JEPQ. I guess I felt obligated in a sense because I've been doing this for a couple of years now to say, hey, here's my top 20.
Dave, you sell covered calls to generate income. Do you think it's something that's simple enough that anyone could do it?
I certainly do. There's definitely a learning curve when it comes to options. There's that hump to get over because there's this, new language and everything else that you have to understand so that you can control your risk when it comes to options. But I do believe that if you put the time and effort into it, that you can learn this material. And once you get there, you can trade options safely, which is, I think, what the goal is. I think people hear the word options and they get really nervous really quickly, but you can definitely do it safely.
And I know you've made some videos about funds that do it for you in exchange for a fee. Do you personally hold some of those as well?
Yeah, I've several because I've reviewed them. I enjoy your content, watching information about other people's thoughts on these ETFs as well. So I've built up a small portion of my portfolio. I think if you're going to be talking about something, you have to kind of experience it. So I've been adding slowly. And I think it's not a bad spot to be in for people especially as they move towards retirement.
Well, then I think that makes you the ideal person to talk about this one approach versus the other. So today we can look at how much you can make by selling covered calls yourself, what you've got to spend in terms of your own time and your own money, or whether it's better to just buy an ETF and let them do the work for you. So this isn't going to be a how-to video. We're not going to get into the technical details. It's more of a, is this something I should learn more about video? If you take a low-risk approach to selling covered calls, how much can you make doing this by yourself?
I think getting started with options, you need to think of it as two trades. I think a lot of times people think that they're so connected, but think of it as two trades. One, you're long equities. You own these stocks, maybe a basket of stocks within an ETF, and then you're selling calls against that position. That's a separate trade. If you go back and think about 2022, when the stock market declined maybe 15%, you were selling calls against that position. You were doing good with the option trades, right? You were making money because the market was declining. So that was a positive. But if you look at 2023, we have this big uptrend. So if you're selling calls against it, you're losing on those calls probably at times, but you're gaining on the equities. When you say how much can you make, it's more about how you want to utilize options. So with a covered call strategy, a lot of times you're smoothing out the ride versus having all the ups and downs that you would have just by owning the equity. I mean, you might target a 10 or 15% return, and that's great. Sounds great. But a lot of that is going to be in years where the market might return 25% or when the market might return 7 or 8%. So you're boosting it a little bit by having those options. So it can be a little misleading when we're talking about a covered call strategy versus an option strategy because that's very defined. So it depends on the market.
Right. And I suppose it depends whether you're talking about total return or just the income portion of it. And I kind of come at this from an income point of view. But if you're buying an ETF, that's going to pay you, if it's JEPI, JEPQ, maybe 7, 8, 9, 10% in income. And then whatever the price does, it depends on the market. If you do your own covered call strategy, are the numbers similar when you annualize them?
I think you can do a little bit better because you have the flexibility to not necessarily sell on the call side. You can also be on the put side. So with the ETFs, it's a very defined strategy. So we know exactly what they're going to do. It's in the prospectus. They spell it out for us. But if you're going to say to me what was profitable this year, it's selling puts versus selling calls. So that's where you can make up that higher number. That's where I think you can compete with the market year in and year out. Because if you're owning equities right now and you're selling puts, you can have a higher return. So I think you can beat JEPI and JEPQ because you have the flexibility of the options and how you manage them.
Right. And those funds sell covered calls on indexes like the S&P 500, for example. Is that something that you focus on too?
Yeah, certainly. I think I would say 70% of my trades are just with things like SPY and QQQ. And that's been some of my recent videos too, is kind of focusing on those two products because they're great to work with, right? If you're new to options, there's lots of volume there, which is great. Open interest, which is great. Expiration dates, so lots of flexibility. So I would say the bulk of my trading is with ETFs. You could also look at things like sector ETFs or bond ETFs like the TLT or LQD. So that's the bulk of it. And then I also do some option trades with individual stocks. But I've been trying to actually reduce that and move more towards ETFs just because they're easier to manage. When you're looking at an individual stock, there's a lot there. And I'm not a stock analyst, and I don't claim to be. So I still do it with products that I like, that I love, that I want to own long term. But my focus is more on the indexes like SPY and QQQ.
So would it be simple to generalize and say that you could make more income if you're doing individual stocks, selling calls on them, but there would be less risk if you're selling calls on indexes?
Yes, there's a lot more volatility in individual stocks. So if you want to collect higher premiums, right? When we sell a call, sell a put, we collect a premium. That's what everybody gets really excited about. At first, it might feel like easy money, but it certainly isn't, and people can be fooled really quickly. But if you do it on SPY or QQQ, those are more stable, less volatility. So the premium you collect is not as attractive. But the trade-off there is that stability, right? So for somebody learning and getting into it, I think those products are more ideal before you really blow up your account really quickly because you make a few mistakes early on.
Right. You mentioned mistakes, which I want to come back to shortly when we talk about risk. But the phrase covered call, that implies that you own the stock, then you sell the call against the stock. But you don't have to. You could sell a call without owning the stock, which would be uncovered. So what would happen in that scenario?
Well, I would say you should call your broker and get to know your broker a little bit. So it's good to have an understanding of how they will handle your situation. For me, and I do a lot of my trading on Fidelity and E-Trade when it comes to options, and it would put me in a short position. So that's okay for me because I'm comfortable with that idea, especially if it's an index like QQQ or SPY. It's not something that I typically do, but I'm okay with it. But if you do it on an individual stock, it's certainly something you want to avoid, right? That's when we start talking about things like the GameStop saga, right? And you can really lose a lot of money really quickly if you're not sharp and aware of what's going on. So it's really important that you have an understanding with your broker, but it'll put you in a short position. And if you don't know what that means, then you shouldn't be in options anyway.
Right. And if I understand correctly, that would mean, say it was an individual stock. You didn't own the stock and you sold the call. Your potential losses could be huge.
Right. Yep. You're going to be short shares, and later on you're going to have to pay that debt. If the stock takes off, right? Your bet when you're short is that you think that the stock is going to be going down. If you're wrong, then there's no cap. So you want to probably get out of that position. And all you have to do is you have to buy back the shares. So if you do that really quickly, it's probably not a problem. But there's been a lot of people and a lot of information. That's why I bring up GameStop, right? Because you've got people betting on one side of the market that it's going to go down because it should. And then you have people that are sort of fixing the market and driving the price up.
And if we were to look at a hypothetical trade over a period of, let's say, 30 days, how much work would you put into that? What's required of you in terms of time?
So there's I love a good spreadsheet. I'm really into that kind of thing. My background is engineering. So, when I started trading options, I developed a spreadsheet and I've stuck with that over the years. So I think it helps you stay engaged too. So there's probably better ways and smarter ways than what I do, but I like to input the data. I like to kind of track it and see where I'm at. That allows me to evaluate each trade, and that takes a couple of minutes. And then on the other side, closing it out, same thing, or rolling the option maybe to a date further out into the future. As far as technical analysis and stuff like that, I don't do a whole lot of that, but some people really love to dive into their Bollinger Bands and do other things like that. But I don't spend a lot of time on technical analysis. And that's one more thing that I think for people that want to get into this, one more reason they should lean towards ETFs and broad-based products, so they don't have to worry about that so much.
And let's go back to risk. What do you think would be the worst thing that could possibly happen if it is a covered call? You do own the underlying. If things go terribly bad, what does that look like if you're selling covered calls?
Well, you're gonna, if you own the stock and you sell a call, you're creating this limiting behavior. So once you get up to your strike price, you no longer are a participant in any kind of market move that would take that stock higher. So the worst thing that could happen is you limit your upside, but you might also think of it as the whipsaw effect would be a big issue. So let's suppose, and this is what a lot of times comes up when we start talking about covered call ETFs. It's those really quick moves higher. Let's say moves up 10% really quickly, right? And you sell a call that was 2% out of the money. So you miss on that 8%. And you're like, oh, darn, that's terrible, right? And then it comes back down next month, 10%. So in that case, if you just own the equity, no harm, no foul, you're right back where you started. But if you sold the call twice, you'd have about a 4% gain, or not a 4% gain, whatever the premiums were that you sold out of the money. But now you're back down to this position and you capped your upside on that big move upwards. So you missed out on that 8% gain and it came all the way back down. So now you actually lost money out of this position. So that's probably the worst thing, is unexpected volatility where volatility isn't expected. Is probably the best way to put it. If that makes sense.
Of all the different option strategies, it sounds like selling covered calls would be the least risky of them.
It is very simple, and it's a great way to get started. You can also define your risk by doing a credit spread, and that would maybe take off some more risk, because then you're basically saying, I own the equity and I want to create some income, but I don't want to, I'm going to cap it by buying a long call as well. And that gets a little bit more detailed, a little more nuanced. So, that's something that usually people start to learn, and we call it, defining our risk. And a great way to picture it is like a Jenga game, right? So the stock takes off and you're poking out one little Jenga piece. That piece you're going to miss out on, but you're still going to get that big upside move. So with stocks like NVIDIA that are just taking off, right? If you're in that stock, by chance, you might look at something like a credit spread versus just selling a call.
Okay, and I know your videos cover all of these different types of option trades, so that's great. Now, I wanted to talk about personalities, because psychology is a big part of investing. So would you be able to describe what kind of investor you think would be better suited to do it themselves versus the kind of investor that maybe should just buy a fund and not even bother with spreadsheets and tracking everything?
Yeah, certainly. I'm notoriously cheap. You can ask my wife and my kids. So I'm always looking at how expensive something is to own it. So if you really want to put the time and the effort and commit the resources to learning about it, I think it can be a big benefit to understand how it all works. But if you don't want to do that, if you want to, be retired, you're out playing golf, you don't want to pay attention to the markets on a daily basis, then it can make a lot of sense to pay that 0.5%, maybe 1% that you might get in some of these different ETFs that generate this income that might be that income replacement for somebody that's now retired, no longer getting that paycheck, but they want to kind of have that paycheck process, right? And I think that's what's so attractive to so many people these days, is they like that monthly paycheck that they used to receive. They don't want to put it into real estate and have to manage real estate. So it's very simple. And I think from an investor standpoint, if you can find something simple that's also motivational and it gets you to invest a little bit more, then that's a great product. So sometimes these things won't return what the market will return, but they're attractive to people because they still give you some upside and it gives you that income.
I've got a friend who does a lot of option trades for income, and he just loves it. To him, it's a game. And he actually lives on this side of the world, and he sets his alarm to wake up at like 2 a.m, because that's when the market is where it needs to be for him to do his trades.
Right.
And he's so passionate about it. So it's an easy choice for him because I think he'd even do it for free. So he's clearly a great fit for doing it himself versus buying the funds. Now, we've talked about calls, and there are also strategies that you cover on your channel about selling cash-covered puts. But when it comes to these funds, they're mostly on the call side. You don't see many of the bigger billion-dollar funds focused on puts. Why do you think that is?
That's a good question. My guess here is that it's simplicity, right? You're seeing more complex strategies come out, right? There's hedged equity ones. There's more and more on the horizon, it seems like, as people are looking at credit spreads and things like that. But with these big funds, they tend to buy these long equity positions, so they own all these stocks. So selling calls is natural because they're not going to just leave money in cash typically. They're going to buy all these stocks, and they're going to sell that covered call. So if you're long equities and you sell puts, a down market could be pretty nasty since you're going to be losing on both the equity side and the put that you're selling. So in that case, they would be scrambling every month to rebalance and still distribute income and those types of things. So it's probably just makes more sense to do it that way.
Okay, so that trend's probably going to continue then. I saw on your channel that you mentioned that selling a put can be a better strategy than placing a limit order if you're going to buy a stock or an index. Could you explain how that works?
Sure, yeah, that's kind of getting paid to wait. So if you just set a limit order, you're waiting for the stock to decline and hit that price. So why not sell a put? Now, when I say that, it's easy to, you need a certain account value, and I think that helps a lot. So if you were going to buy, if you only wanted to buy 10 shares, and this doesn't match up well, but if you were going to buy 100 shares, selling a put, you will collect a premium. If the stock trades sideways, you keep that premium. So that's the payoff here. Whereas if you were just to set a limit order, it's just sitting there not doing anything. So it's kind of nice getting paid to wait and I think that's a good thing for people to understand as they're getting into options. That's one of the things that I think kind of attract people. Starts to make sense. Hey, if nothing else happens here, I'm going to collect a premium. I'm a little bit better off now than I was last month. So,
and also I think that touches on another concept. There are the stocks and funds that you'd like to own that you're a fan of. Then there are the stocks and funds that maybe generate the most income or the optimal option trade, which might be a different set. Would you say that it's better to deal with the stocks and funds that you personally like, that you're happy holding, as opposed to the ones that maybe generate more income?
Absolutely. And we talked about this offline a little bit, but I'm not a fan of products that are going to return and distribute 50%. To me, that really doesn't make any sense. You shouldn't have to manage this yourself. You're doing this, like I said, if you're buying these funds, you want the simplicity of it. You don't want to be managing things. So I like positions that allow for some growth and can distribute some income. So I like a lot of traditional ETFs that are like that as well. I talk about SCHD and some of these other dividend-driven ETFs. And that's, I really like DIVO. That's one that I'm a big fan of because that's most like if you were to look at my account, that's what it would look like. Got stocks, I got ETFs, but I'm not selling calls against all those positions. I'm kind of selectively picking out the ones that I want to do that with. So yeah, I mean, it makes a lot of sense for me to be in products that show some growth and some income. And that's why I'm a fan of JEPI, JEPQ. Those are doing great. I like BALI, BALI from BlackRock. I think that's a great product. I like the NEOS products. I've talked to those guys a few times. I've seen you have too. I think they have some intelligent products, especially for those that are looking for to do it in a taxable account because they've got some nice tax advantages with the 1256 contracts and things like that. So lots of good products out there that I think can offer some growth and some income and not jeopardize what you're doing just to attract people by a huge distribution rate.
And if this discussion has maybe stimulated some interest for the viewers, what would be a good way for them to get into the basics of learning how to sell covered calls or cash covered puts?
You should check out Wealth Adventures. So I've got a bunch of playlists out there. Option Basics Getting Started is one that I started for people to try to cover all the questions that initially come out. Like, what does this mean? How does this work? So that's a step-by-step video series. I think I've got 4 or 5 in that series that kind of show you selling a call, selling a put, buying a call, buying a put. Those are the 4 different basic strategies that build all these complex strategies. That's a good place to start.
Terrific. I'll put a link to that playlist in the description for this video. And if people want to get a sense of you've mentioned some funds, thanks for bringing those up. Those are all great. But if people want to get a sense of just generally from an investing point of view, which stocks and funds you like to hold, is there anywhere where they can see either your portfolio or a portion of your portfolio, maybe some of your larger positions?
Yeah, there's. I did a video not too long ago, which was something I didn't really. I guess I felt obligated in a sense because I've been doing this for a couple of years now to say, hey, here's my top 20 by percentage, just to kind of show people what I do. Investing can be very simple, and I try to point that out on my channel. Like if you're a young person, you're just buying a few ETFs, broad-based index ETFs, you can do great. That can be all you need to do. So in my video, and you can put a link there, you can see my 20 positions that I've got now that I've developed over 30 years of investing. And I think people are like, well, that's so complicated. It does not have to be that way. But that's the way I've chosen to do it as I've gone along. So it could definitely be more simplified. I want to get that out there. But those are my top 20.
Okay, terrific. Well, I'll put a link to that one in the description as well. Dave, thanks for sharing all this. It's really interesting because you've done both sides of it, the funds and doing it yourself. So I really appreciate your time.
Awesome. Thanks for having me on.
You're most welcome. And that wraps it up for this look at do-it-yourself covered calls. More Armchair Income coming soon. Armchair Income.